No change in interest rates, Scarlett, but the Federal Open Market Committee drafted a policy statement with a somewhat hawkish tone, and that's a surprise. Gone is the reference to risks posed by global economic and financial developments, which the Fed used to explain its decision not to change policy back in March. Translation, the Fed is not as concerned about external risks to its outlook, and the focus is back on the domestic economy. As you know, the first paragraph of the policy statement is the most key, and in it we find all kinds of words, all manner of words that paint the picture of a healthier economy with inflation pressures still contained but building. Words like improved, solid, strong, and strengthening. Still absent in the statement is the reference to balanced risks. As you know, there was much focus on this heading into this meeting. And again, the balanced risks has not been seen since the December statement. There are plenty of to-be-sures in this policy statement, slowing growth in household spending, for example, as well as little change in inflation expectations. What's the overall takeaway? This pretty much sums it up. The Fed is trying to create enough room to raise rates at its June meeting without surprising the markets. And of course, the June meeting comes with a revision of economic projections and the dots, as well as a press conference with Janet Yellen, the Fed chair. The Fed also this time reiterated its desire to tighten policy at a quote-unquote gradual pace. Why is that important? Because the Fed is going to have to raise rates soon if it wants to increase borrowing costs by 50 basis points before the end of the year. The conventional wisdom is that the Federal Open Market Committee will be reluctant, if not loath, to tighten policy the closer we get to the election.